What if waiting for this perfect 20% market crash is actually destroying your wealth? Just look at the data from 2021 to 2026. Whether it's the S&P 500 ETF or an income powerhouse like DBS, the bull market runs far longer than the bear. Even if you manage to time the bottom perfectly once, by the time the next crash arrives, the price has already run completely away. Watch this Notebook LM video where an AI host breaks down my latest article on why crash investing is a completely futile exercise.
Welcome to The Explainer. So today we're tackling a massive psychological trap that catches even the absolute most seasoned investors completely off guard. We're talking about the alluring, yet honestly deeply dangerous strategy of crash investing. And more importantly, we're going to look at the hidden cost of waiting that comes right along with it. Look, we all love a good discount, right? But in the financial markets, hunting for that perfect bargain can actually end up costing you a fortune. I want you to just picture this scenario for a second. You wake up, check your phone, and boom, the stock market has just tanked 10% overnight. Instantly, your heart starts racing. You're thinking, this is it. This is exactly the moment I've been hoarding all this cash for. It's time to scoop up those premium businesses at a massive discount. So you open up your brokerage app, your thumb is hovering right there over the buy button. But then this darker thought creeps in. You know the one. What if this is just day one? What if it drops another 10% next week? Are we looking at another 2008? Am I just, catching a falling knife here? And suddenly that thrill of the drop is completely replaced by this paralyzing fear, and you close the app without buying a single share. Sound familiar? Now, in moments like that, you probably try to remind yourself of this legendary quote from Warren Buffett, "Be greedy when others are fearful." And hey, it's a fantastic mantra, but the problem is, so many of us take it way too literally. We assume that hoarding cash and waiting for a catastrophic market crash is some sort of, investment masterstroke. But here's the thing. Buffett isn't a market timer. When he talks about holding cash, it's usually just because he can't find good businesses at reasonable prices, not because he's sitting around waiting for the sky to fall. More importantly, Buffett can afford to be greedy because he has this incredibly deep, foundational knowledge of the companies he buys. If you haven't done that rigorous homework on balance sheets and long-term prospects, being greedy during a panic isn't brave. It's just a recipe for disaster. Okay, let's dive into this. Crash investing is just so much harder in practice than it is in theory. It's incredibly easy to be perfectly rational when the financial weather is sunny and peaceful. But when a real crisis hits, your biology literally takes over. Your anxiety completely hijacks your mental console. Your survival instinct starts screaming at you that buying right now is dangerous, frantically trying to protect you. Basically, during a market crash, your logical brain gets completely locked out. And that emotional paralysis is the exact reason why so many investors freeze up and miss the absolute best entry points in the entire market. Ironically, you become the fearful others that Buffett was talking about. Now, let's say you do have a stomach of steel, you've done your homework, and you know exactly what you want to buy. Even then, pivoting from psychology to the hard data reveals a really critical flaw in this strategy. Historical data proves that trying to time the market by investing strictly during crashes simply does not yield better long-term returns. Why? Well, it comes down to a very basic mathematical reality. Bull markets last significantly longer than bear markets. While the bear roars loudly and violently, the bull runs way farther and for way longer. So when you wait on the sidelines for a crash, you are literally betting against a market that spends the vast majority of its time going up. Now, what's really interesting about this slide is that when we look at the overarching real-world hidden costs of sitting on cash over the past 5 years, a very clear narrative emerges. From 2021 to 2026, we've seen this exact scenario play out in real time. Whether you were looking at a broad growth ETF like the S&P 500 or an income powerhouse like DBS, investors who sat on their hands waiting for that perfect entry point ended up falling into a massive trap. Let's break down exactly how this waiting game played out in real life, starting with the growth side. Take the SPY, the S&P 500 ETF. Let's trace the journey of an investor caught in what we call the waiting trap. Back in mid-2021, the market was high, so you decided to wait. And bingo, in late 2022, a brutal bear market hit. You bravely deployed your cash right at the absolute bottom, buying in at around $360. Brilliant, right? Your strategy worked perfectly. But that success is exactly what springs the trap shut. As the market rebounded in 2023, you decided to play the exact same game with your new savings. You went right back to hoarding cash, waiting for the next big 20% drop. But here is the brutal reality of that decision. 70%. By sitting in cash and waiting for the sky to fall again, you missed out on a staggering 70% gain. That's right, because the market never plunged into another true bear market. Despite, all the geopolitical noise and macro uncertainties, the ETF just kept climbing. It marched all the way from $440 up to $750 over 3 years. Missing out on 70% growth because you wanted a discount, that is the very definition of the hidden cost of waiting. So, the crucial point is the stark mathematical reality you're left with. Let's say your apocalyptic fantasy actually comes true, and there is a massive, catastrophic 20% market crash next week, okay? Well, that crash would only drop the ETF back down to around the $600 level. Think about that for a second. That bargain price you waited 3 whole years for is still 36% higher than the price you flat out refused to pay back in early 2023. You waited years for a crash, and your reward is paying a 36% premium. The math of timing the market simply does not work in your favor. And hey, if you think this is just a problem for growth stocks, think again. Let's shift our focus to a high-quality income stock like DBS Group Holdings. Because if the waiting trap is painful for growth ETFs, the strategy completely collapses when applied to income generators. 5 years ago, DBS was trading at around 27 Singapore dollars. Yes, there was a bout of volatility last year where it dropped 20% to around S37.16. But that dip wasn't a prolonged bear market, it was a fleeting flash sale that slammed shut in a matter of days. The odds of you logging in, overcoming your anxiety, and catching that exact bottom are incredibly slim. And by trying to catch that tiny, elusive flash sale, look at what you gave up. The stock price skyrocketed from S27 5 years ago to over S70 today. That is a massive 169% missed capital gain. All because you were sitting on the sidelines waiting for a perfect storm that never quite arrived the way you wanted it to. And this brilliantly illustrates the ultimate, brutal double penalty of crash investing when it comes to dividend stocks. You didn't just miss that fleeting flash sale at $37.16, and you didn't just lose out on 169% in capital growth. By sitting in cash, you completely forfeited 5 whole years of steadily increasing, compounding dividends. You lost the capital appreciation, and you lost the cash flow. The cost of waiting here isn't just hidden, it is exponentially damaging to your wealth-building journey. Now, I want to be perfectly clear here. Market crashes absolutely are opportunities. They are fantastic windows to add to your positions or rebalance your portfolio. But here is the core thesis of this entire explainer. They only become true opportunities if you are already in the market. You need to have personally experienced its volatility while holding positions. By staying invested through the normal times, you ensure you don't miss out on those long-term, multi-year bull runs. And even more importantly, being in the market helps ensure that anxiety doesn't completely take over your mental control panel when a real drop finally happens, because you're already accustomed to the ride. Let's move to and see how this builds into a much healthier investing mindset. Think of investing exactly like taking a hike up a mountain toward a financial goal. If you sit on the bench waiting for the weather forecast to be absolutely 100% flawless before you start, your hike is literally never going to happen. You'll be waiting forever. In reality, successful investors set off in normal conditions. They pack a rain jacket, which in this case is a well-diversified portfolio, and some emergency cash for the brief storms they know will eventually come, and they just keep moving forward. Even if a sudden storm slows you down, by being on the trail, you get to enjoy the compounding views along the entire journey. So, timing the apocalypse is a futile exercise, and honestly, it is a wildly unreliable investing strategy. You cannot let the fantasy of a perfect market entry point keep you sitting in cash while the rest of the world grows around you. As we wrap up this explainer, I want to leave you with one critical question to ask yourself the next time you think about holding back your capital. Are you letting perfection become the enemy of your progress? Stop paying the hidden cost of waiting, pack your financial rain jacket, and get out there on the trail.